How's it going, everyone? Welcome to the Personal Finance Takeover. My name's Sean. This is my co host, Fabian. The title of today's episode is Options Trading for Beginners Buying a Call. If you like this content, please consider following, downloading, liking, or subscribing, depending on where you're listening. So, you've probably heard that options trading can make you a lot of money, but it could also lose you a lot of money. Options trading is highly risky, so it might not be suitable for every investor. But if you are a risk taker, just know that it will take some time and practice to feel comfortable trading options. So, Fabian, could you tell us what an option is?
Yeah, so an option is a contract you can purchase that gives you the right to buy or sell a stock at an agreed upon price on or before the expiration date. You can also sell an option contract where you will be selling this right and collecting a premium for it. There are two different types of options. There are calls and puts. So a call option gives the option holder the right, but not the obligation to buy shares of an underlying stock at an agreed upon price on or before the expiration date. And a put option is basically the opposite. So this gives the option holder the right, but not the obligation to sell shares of an underlying stock at an agreed upon price on or before the expiration date. The agreed upon price is also known as a strike price. And every option contract has an expiration date, whether it expires a week from now, a month, a year, or so forth. Also, each contract represents 100 shares of the underlying company.
All right, so let me wrap my head around this. So, trading options is buying a contract. And in these contracts, you could buy or sell 100 shares of a stock at the agreed upon price, which is called the strike price. For a call option, you want the stock to go up in value, and the put option, you want the stock to go down in value. So, can you give me an example of this as well?
Yeah. So let's say you are the buyer of a call option for a company, and this is a made up company, FNS Incorporated. The strike price of the contract is $100, and the expiration date is 30 days from now. By holding this contract, you are allowed to purchase 100 shares of the underlying company for $100 a share anytime within the 30 days, regardless of where the stock price is at. So if FNS Incorporated stock is trading at $120 per share, fortunately for you, you own a call option that allows you to buy the stock at $100 a share, even though the stock is currently trading at 120. So now let's say you are the buyer of a put option. Using the previous example, the put option will allow you to sell 100 shares anytime within the 30 days at the strike price of $100 per share, regardless of where the stock is trading. So if the stock of FNS is trading at $80 a share, fortunately for you, you own a put option that will allow you to sell the stock at $100 per share, even though the stock is currently trading at $80. So why would anyone purchase an options contract? So reason one, to speculate the price of the stock. If you think the price of the stock is going to go up, then you can purchase a call option to lock in the strike price, which would allow you to purchase the stock at a lower price if the price goes up. If you think the price of a stock is going down, then you can purchase a put option and profit from the price going down. Reason two is to hedge risk. So options can help protect the value of your stocks if something catastrophic were to happen. Think of it like buying insurance for your assets.
Okay, cool. So that example helps understand it more. When explaining what options are, you mentioned a premium when buying an options contract. So can you explain how to buy an option and where that premium comes in?
Many stockbrokers allow you to trade options on their platforms. Just make sure to meet any requirements, if any, before trading options. Once options trading has been granted, the best way to start is to do research on any company that you might be interested in. Once you have selected a company, determine whether the price will go up or down and pick an expiration date that you think will take for the stock price to move in the desired direction. Just keep in mind that the further out the expiration date is for the contract, the higher the premium cost will be. And this is because the further out the date is, the more time the stock price has to move. You will notice that the options chain, there are various strike prices for each contract. The cost of each contract, also known as a premium, and the break even point.
Okay, so can you give an example of buying a call?
Yeah. So now that you have done your research and you believe that the price of the fictitious company FNS Incorporated stock is going to increase. So currently, the stock is trading for $172.86 per share, and you believe the stock will increase to $175 in 1 month. So you decide to purchase a call option. What you can do is go on your trading platform and select trade options. then select the buy call. Then select a date that is 4 weeks out. And on the options chain, select the $175 strike price. So the price for this contract will cost you $4.30. And since each option contract represents 100 shares, the total cost of this contract is $430. So you take those $4.30 and you multiply them by 100. You notice that the break even price for this contract is $179.30, meaning that the price of the underlying stock needs to increase higher than $179.30 if you plan on exercising this contract. Since the strike price of this contract is above the current price of the stock, we refer to this contract as being out of the money. So now let's look at some of the outcomes if you were to purchase this contract. Scenario one, you are at expiration date and the price of FNS Incorporated stock has skyrocketed to $195. Now that the price of the stock increased higher than the strike price, this contract is referred to as being in the money. So you decide to exercise your right to buy 100 shares at $175. Since you have a contract with the option seller, he is obligated to sell you his 100 shares of FNS Incorporated stock at $175, even though the stock is currently trading at $195. After exercising your right to purchase, you can quickly turn around and sell these 100 shares for a profit. If you want to calculate your total profit from this deal, then all you would have to do is take the $195 and subtract $175, which was strike price, and also subtract the $4.30 of the premium, which would give you $15.70 profit per share. Then multiply the $15.70 times 100, which would give you a final profit of $1,570 for this trade. So now let's look at another scenario. Maybe the stock doesn't go up, maybe it goes down. So scenario two, you held on to the options contract to expiration and the price of FNS Incorporated stock dropped from $179.30 down to $173.50. Since the value of the underlying stock never surpassed the strike price, this contract is considered out of the money and it expires worthless. At this point, it would make no sense to exercise your right to buy the stock at 175 when you could get it at the market rate of 173.50 per share. So you lose your premium paid, which was a $430, and the seller of the contract gets to keep it. So now I'm going to go into scenario three, and I'm going to call this 3A. So you decide that you do not want to exercise the contract, but instead you want to wait for it to appreciate and sell it for a profit. You notice after a week of owning the $175 strike price contract, the value of the contract increased from $430 to $580 since the price of the underlying stock went up. Since your intention was never to exercise this contract, you can sell the contract on the open market and have someone buy it off you for $580. This means you would have profited $150. So to calculate this, you just take the amount you sold it for, which was $580, and you minus the $430 that you bought it for. And you profited $150 after only holding the contract for 1 week. So kind of going down the same route, not wanting to exercise the contract, but maybe holding on to it and hoping to appreciate. So let's see what can happen if the stock begins to fall. So again, since your intention was never to fully exercise this contract, if the value of the contract begins to drop, you can sell it in order to protect your investment from further loss. Now, let's say bad news was released that negatively affected the price of FNS Incorporated stock, and you don't think that the price will recover before your expiration date. So the price of your $175 strike price contract dropped from $430 down to $220. So instead of waiting and having this contract expire worthless, you can sell it for a loss and at least recoup some of your investment. Although never ideal, it is best sometimes to recover some of your investment back instead of losing it completely. So the loss of this deal would be negative $210. So you sold your contract for $220, but you paid $430.
Okay, so those scenarios definitely help understand all this stuff. What are your personal thoughts on options and do you trade them?
Yeah, I personally trade them. I do enjoy it, but I'm super cautious. I don't, consider myself a YOLO investor, and I don't go after all these meme stocks. I just enjoy the small gains and try to protect myself from massive losses. What about your thoughts?
So I personally have not jumped into trading options, but the more I see you go into it and like you show me about it and talk about it all the time, I definitely get more interested. So I'll likely try it out in the near future. And of course, only with money I can afford to lose just in case things go south. So thank you guys for listening. And as always, this is not financial advice. Do your own research before you invest in anything. If you like this content, please share it with one person as this helps us out a lot. Until next time, peace.
Peace.